Alright guys, my name is Shervin, welcome to my channel. Today we entered into a bear market. Now for those of you who don't know, a bear market refers to any time the stock market as a whole drops more than 20% compared to its last high point. And of course, the best way to indicate this is by looking at the performance of the most popular index fund, which would be the S&P 500. Now, the last high point of the S&P 500 was on January 3rd of this year when it reached $4,796 per share. Which means that in order for a bear market to be declared, we needed the S&P 500 to drop below $3,836 and finish a trading day below that amount. Now, over the past month or two, the S&P dabbled below that threshold once or twice, but it never finished the business day below that amount. Well, that is until today, when it actually finished below that threshold, which means that we are now officially in a bear market. Now, if you watch till the end, you're going to find out exactly what this means for your investments, how you should be managing your portfolio during a bear market, and how you should be using this as an opportunity to make money. Now, as always, if you're new to my channel and you enjoy this video, make sure to smash the subscribe button down below and join the community. I make new videos about personal finance and investing on a regular basis, and by subscribing to the channel, you get to see all my new videos right as they come out. Also, if you find this video useful, all that I'm going to ask from you in return is to smash the like button down below for the YouTube algorithm. Now, there's no way for me to know if you dropped a like down below or not, so we're just going to use the honor system here. If you enjoyed the video and you found it useful, one like down below, thank you very much. But with all that said, let's start with what you should be doing with your investment portfolio during a bear market. Now, the first rule of long-term investing is to buy and hold. Let me repeat that one more time just in case that wasn't clear for you. Buy and hold. Now, the buy part is very simple. You just buy into whatever you want to invest into. And the hold part is also pretty simple when the market is going up and the economy is booming and your investments keep growing in value every single day. It's not so simple though when you're in a bear market and your investments keep going down in value. But the thing is, that is the most crucial part by far. The most crucial part of any long-term investing is to hold when the value of the investment is going down. And this is particularly true when you invest into broad index funds, which track the performance of the market as a whole. This is because an important element of long-term investing, and the reason why long-term investing actually works, is that in the long term, the market always goes up in value. Which is another way to say no matter how much the market crashes, it will eventually recover. In fact, if you look at the last couple of bear markets, it took an average of 142 business days for the market to recover. Now, of course, this doesn't mean that this bear market is going to recover exactly 6 months from now. It could take longer, it could take shorter. There is no way to know. The only point that I'm making is that the market always recovers without exception. In fact, if you look at all the previous bear markets, the government or the Federal Reserve always step in with new policies or stimulus checks in order to restore the trust of the investors into the market. And as a result, more investors will come back to put their money into the market and drive the prices up once again. So what this means is that during a bear market, you don't want to sell any of your broad index funds and you want to hold on to them for the long term. Now, I of course completely understand how it feels to look at your portfolio every day and you see the value going down on a daily basis and you just feel stupid for investing and losing your money. But I just want to point out the most common mistake people make when investing for the long term is that when they see the value of their investments going down, they assume they're actually losing money, which is not the case at all. Now, a broad index fund has an average return of 7% per year, which means that if you invest it for many years, you end up averaging it out at about 7% return on investment per year. What this doesn't mean is the notion that every single year your investments will go up 7%. That's not what happens at all. Sometimes they go up, sometimes they go down. It's just that over a number of years, on average, they go up about 7%. Now, for example, let's say you bought 10 shares of an index fund for $1,000 per share. This means that you have $10,000 invested into this index fund and you have 10 shares to show for it. Now, let's say a couple of months later, you encounter a bear market and your investments go down in value, let's say by 20%. Well, now each of those shares are worth $800 and you have $8,000 in total value. Now, an average investor might look at that and say, oh, I've lost $2,000 here, which is not what's happened at all. You had 10 shares before and you still have 10 shares now. You haven't lost anything. In fact, the only thing that the value of your portfolio means is that if you sell your shares today, you will end up losing $2,000. But that's the thing. You don't have to sell your shares today. And in fact, you don't want to sell your shares today. Now, if instead of panicking and selling your shares during a bear market, you just hold on to your investments, let's say in 3 years' time, the market has recovered and it's gone up a little bit too, which is usually what happens after a market recovery. And let's say at this point, 3 years from now, your investments are worth $12,000. Now, this would mean that overall, your investments have gone up 20% in value, which is close to 7% return per year, which is what you were promised. Now, notice that you made that 7% a year by just doing those two things: buying and holding. In fact, the only way you could have lost money from this investment is to panic and sell when the market was down, which is why it's so important for you to implement the buy and hold strategy when it comes to your long-term investments into index funds. But now that we've discussed why you shouldn't sell your long-term investments during a bear market, let's also talk about what you should be doing when it comes to investing more. Because guess what? During a bear market, all the prices are down, which means that you can buy into the market for a discount. So going back to the previous example, instead of having to spend $1,000 per share to invest into your favorite index fund, you would only need to spend $800 per share, which means that a bear market is a great opportunity to invest as usual and get an even higher return when the market eventually recovers. Now, a common question that comes up is, where is the low point? At which point do we know that we're at the bottom of the market so that we can invest and get the highest amount of return possible? Now, the answer to that question is that there is no way to know at which point you're at the bottom of the market, and there's no way to know at what point the market is going to change its trend and start going upwards. Which is why it's a famous saying that instead of focusing on timing the market, you should focus on time in the market. This means that you should look into implementing a strategy known as dollar cost averaging, which basically means you're buying a specific amount on a consistent basis. So this would mean that you buy 1 share a week every single week, regardless of what the price is. Now, of course, that's just an example. You don't have to do 1 share a week. You can do 2 shares a week. You can do 1 share a day. You can do 1 share a month. Doesn't matter how often you're buying, just as long as you're doing it consistently. And by doing so, you're guaranteed that no matter how much the prices go up or down, or at what point we're at the bottom of the market, you're always averaging out the cost of buying that specific index fund in order to get the best deal possible. And of course, it bears repeating that once you buy, just hold. Buy and hold. That's how you invest for the long term. Now, there's one more thing that you should always make sure you have during a bear market, and that is a fully funded emergency fund. Now, experts recommend that you always hold about 3 to 6 months of your expenses in cash in a high interest savings account. Now, this emergency fund is meant to be there just in case any unexpected expenses come up and you need cash right away. So essentially, your emergency fund is a buffer between your unexpected expenses and your investments. Because if you don't have an emergency fund and let's say some expenses come up, you have no choice but to sell off some of your investments, which is the last thing you want to do during a bear market, because anything that you sell, you're guaranteed to lose money on. So instead of falling into that trap, make sure you always have 3 to 6 months of your expenses in a high interest savings account. Now, if you're interested in knowing what the best savings account in Canada is, I've made a full video about that and I'll leave a link to it up here. So essentially, make sure you have 3 to 6 months of your expenses in that account and then spend everything else aggressively investing into index funds, because now is the time to buy. So just to quickly recap what we talked about in this video, first, make sure you don't sell off your long-term investments just because the value of your portfolio is temporarily down. Make sure you use this opportunity and invest into index funds while they're still on a discount. Implement dollar cost averaging in order to get the best return possible. And of course, make sure you have a fully funded emergency fund ready to go just in case anything happens. Alright, so that's about it for this video. Hopefully you guys enjoyed that. Now, as always, if you have any questions about any of the stuff that we talked about in this video, feel free to let me know in the comments down below. I always respond to every single question that comes in. And with all that said, thank you guys so much for watching, and I will see you in the next video. Cheers.